Hello property navigators. Today we'll be discussing some excellent areas in Southeast Queensland worth considering for investment within the $550,000 to $700,000 price range, focusing on two cities located within approximately 30 to 40 minute drive from Brisbane City. The areas we'll introduce today offer both strong imminent price growth potential and strong cash flow. Depending on your investment stage, you might prioritise strong capital growth over cash flow or vice versa. So our discussion will encompass both houses and duplexes. At the end of this video, I'll demonstrate this with examples of property listings of the three different asset types, demonstrating how each could work in various scenarios. I'll begin with an overview of two specific regions, and then I'll narrow that down to suburbs that we will recommend for you today. Let's dive in. First up, we have Ipswich, located just 40 kilometres southwest of Brisbane City. Located in the heart of Southeast Queensland where four highways meet, the city is a national logistics hub. Ipswich's proximity to Brisbane and the Gold Coast provides seamless connectivity to air and seaports, and its inclusion in the Southeast Queensland Regional Plan makes it a key player in the region's development. Ipswich is the oldest provincial city in Queensland. It will also be the fastest growing, with a projected growth of 170% by 2041. The current population of Ipswich is around 253,000 people, and it's expected to grow to 535,000 people by 2046, making it one of the fastest growing cities in Queensland. Due to this growth, it's estimated over 143,000 new homes are going to be needed, stemming from the fact that new infrastructure development is creating new jobs and attracting a strong population of people for employment and lifestyle reasons. Over the next few years, Ipswich's property market is also set to benefit from substantial government spending, with billions of dollars being invested in local infrastructure projects. The Queensland government has committed a ton of spend in the 2023 and 24 budget as per the released regional action plans. As you can see, there's $1.3 billion for infrastructure and capital works, nearly $915 million on health, $315 million on education to improve and upgrade schools, and the list goes on and on and on. And if you look at the total funding of these projects over the coming years of each project, and not just the 23-24 allocation, you'll get a good idea of the billions of dollars being spent. And this is only state funding to the end of 2024, so it doesn't include federal or local government spend or private projects. So let's look at some of these other major infrastructure projects Ipswich has in the pipeline. The Inland Rail project features two separate sections passing through the Ipswich local government area. There's the $1.2 billion Helidon to Calvert line and the $1 billion Calvert to Kangaroo line. So this project carries a price tag of $2.2 billion. The new Mater Hospital project in Springfield will cost $320 million to build and is on track to be completed in 2025. In partnership with the Queensland Government, this project will see more than $1 billion invested over the next decade. The Australian Government has this month committed to building heavy weapon carrier vehicles for Germany to be built at Redbank under a contract valued at €1.9 billion, cementing the Ipswich region as the defence capital of Queensland. We also have to mention the $1.5 billion Ripley Town Centre development, a place where commerce, innovation, retail, health, education and amenity will connect on all levels. A $400 million Frucool Suntory beverage manufacturing facility and warehouse is underway in Swanbank, and $134.5 million of funding has been secured from the federal government to upgrade the Mount Crosby Road interchange on the Warrego Highway, and $42.5 million has been committed to fixing the westbound side of the Bremer River Bridge. There are more than just these projects I've highlighted here, as this area is growing and it's growing fast. On top of these state and federal projects, the Ipswich Council has prepared a new local government infrastructure plan, which includes hundreds of future projects in transport, parks and land for community facilities, worth more than an estimated $3 billion up to 2046. And moving on to the suburb we're going to recommend for you today. Silkstone is a historic and well-established residential suburb located about 4 kilometres east of Ipswich CBD, offering easy access to parks, schools and shopping centres. Property prices are competitive, offering affordable options compared to larger cities, making it accessible for investors and first-time buyers. According to CoreLogic data, the median price in Silkstone was $259,000 in 2014, and it has risen approximately to $584,000 in 2024, reflecting an average annual growth rate of around 7.5% over the past decade. This steady growth indicates a strong investment potential driven by ongoing regional development and infrastructure projects. In 2022, growth sat at 39%, backing off to 4% in 2023, and it's looking to re-accelerate again in 2024. In the decade between 2010 and 2020, the average growth rate was 1.3%. Property prices only went from $291,000 to $308,000. So whilst recent growth surges have been incredibly beneficial for this market, it underperformed for 10 years prior to the recent uptick, leaving the door open for strong short-term growth. The rental market in Silkstone is tight, with a vacancy rate of around 0.6% according to SQM research, dropping from a vacancy rate of 2.1% in 2020 and raising no higher than 1.1% over the past 4 years. This consistently low vacancy rate indicates strong demand for rental properties, providing a favourable environment for property investors seeking stable rental income. 3 properties sold last month out of 13 listings, meaning there is 4.3 months of stock available. When there is less than 6 months worth of stock, it represents a market with further pressure on prices predicted. This stock level has been trending down, signalling a market that will have continued strong short and medium term demand. If it was trending up, the opposite for this market could be telling a different story. Approximately 66% of properties in Silkstone are owner-occupied, while about 34% are rented. This balanced mix ensures a stable market environment and reduces the risk of significant price volatility. Investors in Silkstone can expect healthy rental yields due to strong rental demand and low vacancy rates. The average rental yield for houses is around 4.6 to 4.9% per annum. With continued population growth, rental yields are expected to increase up to about 6.1% over the medium to long-term 3 to 5 year outlook, based on the assumption you're purchasing a house today. Silkstone offers a compelling investment opportunity with affordable entry points, robust rental yields, and potential for capital growth. The suburb's family-friendly environment, characterised by parks, schools, and shopping centres, enhances its appeal. Coupled with ongoing regional development and infrastructure projects, Silkstone's property market is well positioned to benefit from this increased economic activity. Stick around to the end of the next section and I'll run you through particular asset types you could purchase and how they could work for you given your own situation. Secondly, today we have Logan, located just 30 kilometres southeast of Brisbane CBD and about 60 kilometres from the Gold Coast. It also neighbours Ipswich, about 40 kilometres to the west. With a significant existing infrastructure to service a growing population and easy access to air, sea and rail ports, Logan is well positioned to support the growing Southeast Queensland region and is attracting a wide range of industry and development. For the 2022 and 23 financial year, Logan was the fastest growing local government area in Queensland with a growth rate of 4.1%. The Logan region is forecast to add just under 173,000 people by 2041, a 48% increase in its 2021 population, bringing it to 548,000 residents. Logan and neighbouring Ipswich are predicted to grow more by percentage than any other council region in Southeast Queensland over the next 20 years. Believe me, we have looked at every single one of them. I want to take a moment here to point out 2 of Logan's priority development areas. Now, priority development areas, or PDAs as they're called, are parcels of land within Queensland identified for land development to deliver significant benefits to the community. The 2 we'll talk about today in Logan are the Greater Flagstone and Yarrabilba. They'll be home to 170,000 people in the next 20 to 30 years, slightly less than half of the city's total growth. The Greater Flagstone PDA covers 7,188 hectares and is expected to provide approximately 51,000 dwellings to house a population of up to 138,000 people. Full development of the $6.7 billion Greater Flagstone PDA is expected to take 30 to 40 years. The Yarrabilba PDA covers 2,222 hectares and when fully developed is expected to provide up to 20,000 dwellings to house a population of up to 50,000 people. Full development of the Yarrabilba PDA is expected to take 20 to 30 years also. So some massive undertakings going on here to provide for the growth in the region. Logan has a very healthy infrastructure project pipeline, having a ton of committed funding in the Queensland 2023 and 24 budget as per the released regional action plans. As you can see, there's $1.4 billion for infrastructure and capital works, nearly $3.4 billion on health, $127 million on education to improve and upgrade schools, and the list goes on and on and on. If you look at the total funding of these projects over the coming years of each project, and not just the 23-24 allocation, you can get a good idea of the billions of dollars being spent. And this is only state funding to the end of 2024, so it doesn't include federal or local government spend or private projects. As per the Logan Office of Economic Development, collectively an unprecedented infrastructure investment of more than $18 billion of publicly funded projects are now underway. So let's look at some of this list of Logan's other major investment projects. First up, we have the $2.6 billion Gold Coast and Logan rail improvements, which is currently underway and includes a $173.8 million Logan Lee station relocation and upgrade to better connect customers with nearby health, education and community services, particularly Logan's new $1 billion hospital. The broader Logan and Gold Coast Faster Rail project is jointly funded by the Queensland and Australian governments with the cost of $5.75 billion. The Pacific Motorway 8-mile plains to Daisy Hill upgrade is underway and due for completion at the end of this year at a cost of $750 million. The Daisy Hill to Logan Motorway third stage upgrade program that has recently had a revised cost of $4.5 billion. Then there's the Coomera Connector. This is a $5.2 billion project providing a second connection from Logan to the Gold Coast. There are many stages to this project directly in this region. There is also the $2 billion Crestmead Logistics estate that ranks amongst Queensland's most significant industrial developments and is set to have about 1 million square metres of logistics and warehouse space. There's the concurrent $500 million Maple Tree Logistics Park that recently secured yet another site beside the industrial estate worth $53 million to expand a further 18.6 hectares, adding to the already 36 hectare footprint. These projects are not a full list in any way, but collectively reflect Logan's growth trajectory, so you can go and perform your own research. This type of infrastructure spend isn't undertaken when a region isn't growing heavily in the future. These projects also mean an absolute shitload of jobs. A shitload. And jobs need people, and people need places to live. Moving on to the suburb we are going to profile exclusively for you guys today. Our pick is Heritage Park. Heritage Park is a suburb situated in the city of Logan. Known for its family-friendly atmosphere and well-maintained green spaces, Heritage Park offers residents a peaceful suburban lifestyle with easy access to urban amenities, making it popular amongst families and professionals. Heritage Park's property market is known for its relative affordability compared to Brisbane's inner suburbs. The median house price in Heritage Park has risen from around $394,000 in 2014 to approximately $822,000 in 2024. Reflecting an average annual growth of about 10.3%. Yet, there is still plenty of deals to be found under $700,000. So for the keen investor, you need to move quick, and you need to move quick now. This steady appreciation in property values is driven by the suburb's attractive lifestyle offerings and ongoing infrastructure developments in the Logan area. In the decade between 2010 and 2020, the average growth rate was only 1.9%, with the median property prices only going from $409,000 to $462,000. So whilst recent growth surges have been incredibly beneficial for this market, the market was subdued for the decade. For context, working off the principle houses double every 10 years, which for the most part, if you invest correctly, they should, then Heritage Park should have reached circa $800,000 by 2020. As we know, properties work in cycles and have periods of high growth and low growth, no growth, and everything else in between. We have a whole video on this, and the link's down in the description. If we forecast out the next decade between 2020 and 2030, then the median price in this location should tip into the mid $1 million range. Heritage Park's vacancy rate is sitting at 0.5%. Vacancy rates peaked at 3.3% at the end of 2019, and over the past 4 years has remained below 1.2%. This shows the strength of the rental market, and with limited new supply incoming, this isn't expected to change. Heritage Park has a moderate stock level with a steady supply of housing options. As of the latest data, there are about 11 houses for sale and 3 houses for rent. A low stock level means there are demand pressures in this market. 15 properties were listed in the past month, and 6 properties sold on average per month, meaning there's approximately 2 months worth of supply on the market. Less than 3 months worth of inventory means there are strong demand pressures on this market, with significant pressure for this market to keep growing in the short term. Approximately 76% of the properties in Heritage Park are owner-occupied, while around 24% are rented. This mix creates a stable market environment with solid demand from both buyers and renters, helping to maintain property values and rental yields. Investors in Heritage Park can expect healthy rental yields, currently averaging around 4.4% per annum, and we estimate this to increase up to about 5.6% over the medium to long-term 3 to 5 year outlook. Heritage Park presents a compelling investment opportunity for property investors seeking an affordable entry point, strong yields, and capital growth. The suburb's location within Logan, combined with its family-friendly amenities and ongoing regional development, makes it an attractive option for both short-term rental income increases and long-term capital appreciation. As I mentioned at the start of this video, we picked these suburbs because we believe they will perform very well by providing both strong imminent price growth potential with strong cash flow. While we can give you these tips, you need to figure out yourself what dwelling type you should purchase for your circumstances. That could be either a 3-bedroom or 4-bedroom house, or possibly even a duplex. For example, let's assume you have a smaller budget that allows for you to buy a solid foundational property. Let's say a basic 3-bedroom, 1-bath house on a good sized block. We found this past listing as a good example. Here is a 3-bedroom, 1-bathroom home in Silkstone on a 776 square metre block with drivable side access for a granny flat that sold for $610,000 in April. 3-bed properties in the suburb that aren't as nice as this one are renting between $510 and $550 per week. So let's say we rent this out at $540 per week, so it's producing a 4.6% yield. If you had a little more to spend, here's a 4-bedroom, 2-bathroom property in Heritage Park on a 705 square metre block with ample yard for a granny flat that sold for $632,000 in March. It was a steal for that price. It's a bit tired, but nothing a lick of paint and some love couldn't fix. We know from looking at RP data that there are 4-bedroom, 2-bathroom houses on similar sized blocks renting for between $590 and $625 per week. So let's choose the middle of that range and rent it out at $605 per week, giving us a yield of 5.18%. By purchasing either of these, and with the growth we are predicting from the work our data team has performed, you will achieve above average capital growth, especially considering these larger block sizes, as it is the land that appreciates in value. However, you still haven't maximized your cash flow due to your lower budget. Strategically, you can then work on improving cash flow at a later time. Let's say you can release some equity in years 2 to 3 and at a granny flat. PS, we have a whole video specifically on this, and the link is down in the description. By adding a granny flat and spending, say, $150,000 to $200,000 on that project, you could then rent that out from $330 to $450 per week, depending on your region. Adding this rental cash flow with the rental cash flow from the original dwelling would seriously improve short and long-term cash flows, whilst also lowering the overall risk profile of the asset, as it would be benefiting from 2 income strategies and not just one. But what if your investment strategy required you to maximize your cash flow immediately while still producing strong capital growth? Well, you could put the granny flat on it right away if you had the budget, but many of us don't. So you could look at purchasing a duplex property. Here is a past listing for a duplex in Silkstone on an 802 square metre block that sold for $720,000 also in March. So a slightly larger block size and a higher price, and just a pinch over the $700,000 range. But the deal stacks up, and I'll show you why. This duplex has a 2-bedroom, 1-bathroom on both sides, and an almost identical duplex property in the same street we found on RP data went under lease in February for $450 per week. Using this same rent amount, this property could give a gross yield of $900 per week, providing a 6.5% yield from the get-go. And you may still receive a higher capital growth yield given this is a larger block. So you can see here the different options you have given your budget and strategy. This comparison between the 3 different asset types demonstrates how you can choose the particular dwelling you need specifically for what is required for your particular circumstances and budget. This should be carefully considered in your investment strategy, which will depend on where you're up to in your investment journey or what your portfolio needs.
Now, if you really like the idea of using the granny flat strategy to have high yield from the get-go, but only have a budget of $700,000, check out this video here. We focus on regions and suburbs in the price range from $450,000 to $600,000. So if you were to pick up a $500,000 property and then use the granny flat strategy, you could be all in for around that $700,000 budget, but have an awesome yield from the very start. Until next time, happy property navigating.